Hello, everyone. This is Brainiac FX bringing to you another episode on supply and demand flip zones. Many of you might know what supply and demand flip zones is, and if you're a new subscriber who is just introducing to smart money concept and you really want to know what supply and demand flip is, this is also a best video for you. Before we proceed, please, I need you to support our FX, like, subscribe, and share the link to the YouTube channel with your friends, right? Without further ado, let's go straight into what supply and demand flip zone is, right? This is my own point of view. These are my own point of view. You might have what is working for you, fine, but this is what I do when I'm trying to trade supply and demand flip zones. And I do hope this video is going to help you and improve your knowledge on supply and demand flip zones, right? So basically, I have three models I'll show you right now, and which of these models did I find I probable, right? So now this is the first one. What does supply mean? Supply is an area we sell from, and demand is an area we buy from, right? So when we get to supply, we know very well that we're looking for sales, and we went to demand, we know we are looking for buy. So the flip zones of these two terminologies means that when we are looking to buy off a demand and the demand fail, right? That means we will be looking at the supply that did fail the demand. In this context, it is referred to as demand to supply, which is an exchange of hands between the demand and supply. But in this case, the supply overcame the demand and the supply were in control. If it's a case of supply to demand, it's going to be uh, that supply field and demand are in control. But these three models I'm showing you is basically the case of demand to supply. So for the first one year, we see that this low right there led to this high to be broken, and we have a break of structure to the upside, creating a new uh, higher high. So that means the higher low took out liquidity and it does break structure to the upside. After structure is broken to the upside, we did expect that there is going to be a pullback into the demand because this was a demand that led to a break of structure to the upside, right? So this was a demand that led to a significant break of structure to the upside. So when we know that this is a demand that led to a break of structure to the upside, we expect to trade an order block or a fair value gap within the leg that led to the break of structure, and that zone is at demand level. But in this case, the demand rallied up a bit and failed to break above this high to form a new higher high. You could see that this high failed to break above this, but then collapsed, right? So in the context where this collapse means that what our demand zones here had failed. And what do you want to do? You want to take a positions back from the supply that allow this demand to fail, thereby looking for sell continuations, right? Now, that is a very first model of demand to supply, right? So in the case whereby this had failed and this had taken place and the demand has failed, that zone is referred to as the flip zones. But the flip zones of this pattern is what? A demand to supply. So for the second model, it's a similar one to the first model, but there is a little different from this model. Now, you want to understand that as a smart money trader, we take liquidity as a priority. We know that if you do not see the liquidity, you are the liquidity. So you have to spot out the liquidity before you engage in trades. So in this first model, there is no form of internal liquidity before the demand was flipped, right? But in this one, there is an internal reactions before the demand was flipped. This I right here was an internal high that got run before the demand got flipped, right? In this case, there is a sweep of liquidity, but here there is no sweep of liquidity. So how do we use this? We understand that now we prefer to see a sweep of liquidity, then we can confidently take a sell from the supply, right? So this is the second model. For this first model, I do not like to trade the first model. For me, I make sure that I don't trade this first model. Now, I did like to trade this model, right? I did like to trade this second model, which is this. So I always prefer to trade this second model, right? The second model, because what not, it took out this high, and the high that was responsible for this price has failed to break above, means that the high here is protected, and the demand, which is also responsible to push price higher, also failed. But before that price got filled by the supply, we see that the is an internal price action that was a liquidity grab before the sell. Now, which makes this a very good probable setup for sell trade. Now, the third one model is also very, very much similar to the second model. But the difference between the third model and the second model is that the third model also have a very good criteria for smart money engagement, right? So for the third model, we have the same thing. We also have a sweep of liquidity right here. So we also sweep liquidity there, and we broke lower, meaning that this high was responsible for the demand to fail. And this is our flip zones where supply are now in control. But in terms of smart money trader, we'd like to see a sweep of liquidity and also inducement, meaning that we want to see a trap of early traders. Now, this is an inducement into a supply. Now, this inducement tells us that now this supply should be protected. I didn't say will be protected. It means should be protected, because we can never be sure of what is going to happen in the market. So this is also a kind of trade I always like to trade as well, waiting for this market to take out the inducement and sell off to the downside. Also, I like to see this type of model as well. So if you ask me as a trader, which of these models will I prefer to trade? I wouldn't prefer to trade the first one, because there is no inducement and there is no liquidity grab before the demand fail. Because in this case, price can trade higher like this and take you out of your positions before the major sell. Because now that there is no inducement and there's no liquidity grab, means that you are going to be the liquidity grab, or you are going to be the inducement. So that is why I prefer to use this model, which is the second model or the third model. But in most cases, this third model is more high probable than the second model. But these two models are a very good supply and demand flip model that you can use. So if you want to use the this is a demand to supply model, right? So if you are trying to look for the supply to demand, it does means that in the case whereby we have a supply that failed, right? Let's say in the case that we have the supply now where we are looking for long position, short positions here, eventually failed to the upside. That means now our supply has failed, and we'll be looking to take a trade of the demand. And in this case, it is referred to as a supply to demand flip, right? So that is what a supply to demand flip, because now the, the supply has failed and the demand are totally in control. I hope you understand this. So I'll give you one example on the case of demand to supply flip, and you can try as much as possible to work on this, check your chart, and be able to implement this on other time frame as well. So in the case of this move right there, you'll see that here we have been creating a series of highs. Take a look at this. You see that market has been bullish, so this market has been very, very much bullish. And where was the last high that led to the previous high? You see this high here. We created a higher low, a higher high, higher low, higher high, higher low, higher high, higher low, and we created a new higher high. But now this is our last higher low that created this higher high. We expect that the market now is going to use its demand right there, because there is a clean order blocks, right? There is a clean order block here that the price can use as end reasons for long positions, because why not, this level right there took out the previous candle that we have right here and also break structure higher to the upside. So ideally, we expect price to come into these zones and trade higher. But look at this market very well. What do you see? You see that price has definitely reacted of that demand and price push up. And here on the 3 minute time frame, take a look at what you see right there. Now, you'd see that price now came into this now. So price swap this low, this high that you can see right there. So this high that you see actually swapped the previous candle before we trade lower. The first candle of the demand had no closure above, means that it's just a mitigation of that zone and price seeking higher. But then the second pullback actually had market traded lower, right? Market traded lower and took our liquidity. So when this demand actually happens, this is what a demand zones, right? So this become a demand level, right? So this is our demand. This is our demand. And here is our supply because this was a large zone here. Let's go into the 1 minute to make things more clearer. Okay. Back to what I'm explaining right there. So you see that our demand at this point was this, and on the 1 minute, we see that this was a last zones that was not fully mitigated, which is now potentially our supply zone. So this becomes our supply on 1 minute. Now, what do we see is become our supply level. So what do we see after that supply was formed? Prices traded lower and the demand failed. So these zones become potentially the demand to supply zones because demand has failed and supply are now in control. Now that supply are in control, what do we see again after price grab liquidity? We created an inducement, right? We created this inducement right here. So we did create a form of inducement above this level, right? So this is a typical inducement that was created and price used that inducement as entry into our supply, right? When price came into supply, this is a type of third model demand to supply. So your entry is basically going to be of this supply. Since inducement has been created, your stops above that, which is going to give you a very good risk to reward, right? And you can continue on the sell bias of the market. You see how the context of demand and supply failing can help you, improve your trading skills. Now, this type of model is the third model which I've explained to you, which I do tell you that I prefer to see this model most of the time because it works most of the time. You can do a back test on this yourself and see how this supply to demand flip actually work or a demand to supply flip actually work. I hope you enjoy these sessions. I hope you learned something from it. Good luck and God bless you all. Peace out.